needle on the record.
Welcome to Cucking with Jmo.
Welcome to another episode of Cucking with Jmo. Today we have a special guest, Matt from Tapioca DAO. How you doing, Matt?
Oh, doing great. Awesome to be here. I just found out about Wage Cucking probably a few months ago when Brian was on, so it's very cool to be on.
Cool. It's nice to have you. Before we get started talking about Tapioca DAO, you want to give me a quick background of how you got into crypto, especially building DeFi products?
Oh man, it's quite the story. But so basically, like, oh man, probably 12 years ago, I was playing this game online, and you'd win these like BTM, like tokens, and it was Bitcoin. And then I got into like Bitcoin itself and everything like that, and I basically immediately got addicted. And then probably going on from there, I was into like, especially when 2017, 2018 rolled around, and like actual DeFi started coming out, and there was things like bit shares and all these like, Dan Larimer moving on to like EOS and Ethereum itself coming out. I was like super addicted. And then by the time 2020 rolled around and you had like actual like DeFi that we know today around, I was like, just like it was like my day to day, like every day was filled with something to do with DeFi. So yeah, it just kind of went from there. My background is in kind of like gambling sportsbooks type software. Basically, I've always been kind of in it from like a product manager development type side of it. So of course it was very natural from getting super obsessed with DeFi and having like a, kind of like a software development background, that these two things kind of came together, and here we are.
Yeah, very cool. I feel like I got into DeFi like about the same time.
Nice.
Like in 2017, there wasn't like, we call it DeFi, but there really wasn't really much you could do on chain. It was just like, ICOs, we can mint ERC20 tokens, and then there's future promise of maybe we'll build something. But then like the first DeFi summer started with like I was farming yams, and then
yams,
sushi swaps, stuff like that. It was fun times. That was the first time in a while.
That stuff was fun. Like sushi swap, yams, ample for like it was all a lot of fun.
For sure.
Yeah, sorry.
It was like the first iterations of protocols like that felt like something like a new primitive in crypto. Like you log on, super shitty UI, you just like click a few buttons, you can harvest your yams, stuff like that. But before we get to talking about Tapioca DAO, I just wanted to get your take on like the current state of DeFi, and what you think are the major issues it faces today.
Yeah, no. So I've thought that DeFi has been in a almost broken state for probably about 2 years now. Pretty much when we started building, I just feel like we've lost the plot like so much. Like as far as like, what are the big things going on right now? Well, you have like points, like, we're given like napkins with IOU written on it, and that have no discernible value, that I could just change whatever they're worth any day I want. Like if I'm the issuer, you have protocols that are becoming more and more like multi-sigs, just controlling a bunch of money, a bunch of funds. And you're having more of a like a of kind of that we're kind of just losing the D part in DeFi, and it's just kind of becoming a worse Web 2 experience. And that's always been something like why we even started this, just because I liked like real DeFi, like back like what we're talking about, like Yearn, Liquidity, Aave, Uniswap, like that's the stuff I liked. And I think we've strayed so far away from that at this point that it's kind of devolved into just like complete gambling. Like, okay, what's this speculative airdrop going to be? And like it just lost the whole meaning and purpose.
Yeah, I feel the same. A lot of what's going on in DeFi now isn't like real sustainable yield. It's not real, innovation, right?
Yep.
So like, I feel like the whole, you talk about the points, I call it the points meta, but
Yeah.
basically there's basically money being printed out of thin air, or like future money being printed out of thin air. And
Yeah.
then with the whole like demand for, I mean, I think it's mostly rooted from like Ethereum, like first you stake it on like Beacon Chain, and then you can like restake it to something like Eigenlayer, and then like whether you operate like an L2 or you operate like, like a separate protocol, you basically asked like individuals to lock liquidity, or restake their restake tokens with you.
Yep.
And then you just get points on points on points. But like, I feel like this is going to fall out of favor pretty soon, just because like, obviously people are doing it. Like if you look at like something like Blast or something like Eigenlayer, like that they generate billions and billions in TVL like very quickly, but without like even like a working product, or even like like anything really going for them.
Well, yeah. Yeah.
Yeah, so
And
I just feel like it'll fall eventually, when individuals like lock up huge amounts of liquidity for in like what I consider like a pretty crowded position for this amount of time, and then the returns, like as the market is unable to support these new tokens, gets worse and worse. We should move to something new.
well, yeah, and that's where I'm coming at it from. I've always said to people, points is liquidity mining without an estimable APY.
Mm-hmm.
Except there are parties who know what the APY is, because they know how many tokens are going to be put out against those points, and they know what a realistic market valuation is for those tokens. So then they can go, okay, I know how much that this is going to yield out. And what's that? That's stock market, where you have people who have inside knowledge who can out trade others. And it just like liquidity mining, when we had like Geist, Olympus, Sushi, Yams, where we had these huge APYs. Well, what happens? They get diluted, and then they go to near zero. And the same thing's going to happen with points, where people are going to, like you're saying, people are going to start putting in a ton of money, but then the return's going to be nothing. It's going to be peanuts. And then they're going to slowly go, I hate this. I don't want, I won't play.
I'm not going to move to the next like L2 that promises a points program, because the previous ones aren't working well. Yeah. So for those who don't know what like liquidity mining is, it's essentially when a protocol prints their own token and incentivizes liquidity onto the platform. So like a lot of these examples, like you talk about Geist, I feel like that's a pretty prominent model for like the borrow lend platforms. Basically, they print their own native token, then they incentivize both sides of the borrow and the lend. So it basically facilitates people to loop their positions, by like deposit assets, borrow against them, redeposit those assets, borrow against them, in order to generate this token, which on paper makes the DeFi protocol look way bigger than it is, because the TVL is like repeatedly counted. But like, I would agree it's like a pretty broken model, because in the end of the day, like there aren't, even despite what the numbers say, there aren't that many people like borrowing and lending. It's just like the same person borrowing, lending, and then the rates aren't generated from like actual use of the platform. It's from the emissions token. So like you're maybe getting like a few percentage points on say your USD, but you're getting like 30-40 percentage points on this token. But then like in general, like this is not a really sustainable model, because like if you're a DeFi participant, and if you're like a DeFi farmer, like the tokenomics of or like your strategy is essentially to dump the token, right? Like you see the token as yield, and you're converting the token back to your like original. So like
it's an interest rate arbitrage, and at some point the token's going to fall in value, and then now you can't pay people to borrow anymore, and now they go to the next shiny thing and the next shiny thing. And that's why I think we've been stuck where there's no innovation, because it's just like fork Aave, fork liquidity, throw liquidity mining program, token goes down, let's make another let's make like, and you're not doing anything.
That was one thing I had written down I wanted to mention was it seems like So Tapioca DAO, I guess we'll get into later, has like a money market component to it. And it feels like the current state of like the crypto money markets, where you can borrow assets, lend assets, it's gotten like pretty stagnant. There hasn't been like that much innovation in like the past, I want to say like 3-4 years. Like the biggest market players, stuff like Maker, Aave, Compound, are still, like the biggest ones, and there have been like some smaller innovations, but mostly the core product remains unchanged. And then
Yep.
like a lot of the new protocols are essentially like, I want to say like a majority of the bigger new protocols are essentially forks of either something like Compound or Aave, where they add like some sort of like liquidity mining, some sort of tokenomics. But it
Yep.
doesn't seem like there is much real innovation, which I guess we can get to talking about how Tapioca DAO works. One other thing I wanted to mention, though, before we get to is like in relation to Tapioca DAO, I think a few issues with the current problems of DeFi is that because now, like this isn't like 2020 where everything was on Ethereum and maybe like like BSC or like a few alt L1s. We live in a world where there's like a huge landscape of L1s. There's a huge landscape of like Ethereum L2s now. And generally like the liquidity is fragmented like pretty heavily. And then like the bridging process is still a pretty big nightmare.
Yeah.
Like it's difficult to figure out which third party bridges to trust. Like if you look at the historic numbers of like the biggest hacks in DeFi, a majority of them are through bridges. Most of the Ethereum L2 native bridges, there's a pretty long wait time to return assets back to L1, which like ties up liquidity. So to expand on that, let's talk a little bit about Tapioca DAO, specifically their. Is it USDO or USD zero? I don't know how you guys call
USDO. It
USDO,
used to
okay,
be USD zero. We dropped it because you couldn't cash tag it.
I see. Okay, so the USD zero stablecoin, which as far as I understand is like an omni-chain stablecoin using the layer zero. Was it the OFT 20 standard? Basically, you're able to transfer the token across various chains without like the actual bridging process or the rest of the bridging process. So yeah, I guess talk a little bit about Tapioca DAO and how it works.
Yeah, no. So we've already talked about a few problem areas. So I think it's a good way to tie it together. Like, why did we build this at all? So there's kind of three core things that we were looking at. Was number one, like I felt like economically, and we were just talking about this with points and liquidity mining, that DeFi has been broken for like the past couple of years, that nobody's ever really created like a sustainable economic model for a DeFi protocol beyond just there is no token model like Uniswap or Maker. Yeah. So that's kind of the first problem. And incentives are very powerful in getting people, like we saw at SushiSwap. SushiSwap was competing with Uni for a while just based off incentives. So that's kind of the first thing. The second thing is we are, like you just said, we're moving in a landscape where it used to be Ethereum, then you had like BSC, then you had maybe Solana and maybe Polygon. So you had maybe those, but I mean, honestly, BSC, Solana, and Polygon were like this, and Ethereum was like all of this. So it was very, very small to even talk about. But now that's not the case anymore. You have Arbitrum, you have Optimism, Base, Blast. You have 100 L2s. You have L1s popping up like Barachain, Monad. Solana's had a resurgence, etc. So the problem is, like with existing models like an Aave or a Uniswap, they have to deploy the entire contract stack to each one of these chains, and then they have to manage it on all of these chains. So it's not scalable to say, I'm going to deploy Aave on 50 chains. Like it just would require so much coordination and capital to do that. It would be almost impossible, but that's where we're moving. So that's kind of the second thing, is the fragmentation that we're talking about. And the third thing has just been stablecoin wise. Like back in 2019, we had DAI, which was just backed by Ethereum, and that was it. Now it's backed by all this other stuff, and you have a lot of risk there. You have Athena, which just came out, which has its own risks and things like that. There's not really a purely decentralized stablecoin that it's going to be worth one based on there's more money in than out. Like just a very simple concept. Yeah. So those were like the three things we wanted to attack, which was like economics, fragmentation, and stable coins. Like how do we kind of mold these three things together? And that's how we kind of came up on the Tapioca concept of addressing each of those three things in one protocol that can do all of that. So yeah, that's kind of a good starting point.
that makes sense. When you say Aave, like it's difficult for them to deploy on 50 chains. I think the other issue is that like the money markets on Aave on each chain are completely fragmented from one another.
Yeah.
Like it's not like they're deploying the same Aave on Ethereum on like each L2, right? So like you have different standards of tokens, different stable
Different
coins,
interest
different
rates.
pools. Yeah, different interest rates. Exactly.
Right.
So it it may seem like you're on the same Aave, but like the parameters, like the
No.
users, the liquidity, like might be completely different to a point where like it's a different protocol. And
Yep.
it would make sense if like there could be like, it'd be awesome if there was like a universal Aave, right? Like every chain connects to the same liquidity pool. Like markets would be like far more efficient.
That's what we're doing. That's what we're doing.
Exactly. Yeah, exactly. And then like I think another issue with these is like the issues with all these forks is that they don't like you can fork like a protocol, but it doesn't necessarily inherit like the team or like the like
the security
the risk parameters, the security. Yeah, exactly.
Yeah.
And like I think a good example you mentioned Athena. I think a good example was Uwu Finance. I don't know if you know about Uwu Finance, but they got exploited for I believe it's like a fork of it's like a Aave fork.
Aave,
but they had like a different set of risk parameters for using Athena's USDE than like the actual Aave. And
even look at Blast. You had someone fork Aave on Blast, and they didn't know what the difference between an LCR and a CR was, and they liquidated $80 million just because they literally didn't know the difference.
Yeah.
You've had Radiant get hacked, Pike get hacked, Prisma get hacked. These are all forks, getting hacked. So
it's important to note that like the forks don't inherit all the like you can fork the code and like redeploy it wherever and make some minor adjustments, but like like the major protocols are at the top for a reason. They're like battle tested, they're actively managed by like a solid team, like as new tokens or as especially in like borrow lend markets. I think it's very important, like as new tokens like come in and out of the ecosystem and they're either being borrowed, lent, used for collateral, like each individual token has like different risk parameters that need to be adjusted like in real time, and if you're not doing that, then like it causes major issues.
And that's why I think a lot of people look at this wrong, like, oh well, Aave doesn't have these features, it's been stagnant. Yes, but why do people lend Aaves? Because they've remained secure, they spend millions of dollars on security, they have the best of the best as far as risk goes. And that's why we've spent $2 million on security. We have 20 audits. Why we employ Chaos Labs, who's the same people who do Aave's risk parameters, one of the groups that do Aave's risk parameters. Like it's the same thing, and you have to get those same things, and it's a lot of money, it's a lot of coordination, it takes a lot of knowledge and skills to do all of that, like as a new protocol. And it's still going to take time, like to build that Lindy, but that's how they've gotten there.
So with Tapioca DAO, I think like I don't know if this is accurate, but I think in my eyes, like the closest comparison to what's been done in the space before is something like Abracadabra's MIM stablecoin, or like possibly like the Alchemist ALUSD, essentially like a collateralized debt position, although those aren't exactly omni-chain. I guess MIM is on a few chains.
I always say probably like it's starting to happen now, but like if you look at like Maker and Spark, Curve and Llama Lend, Aave and Go, that's kind of the you have like those a money market and a stable coin that are kind of attached to one another, and that's pretty much what Tapioca is, all in one though.
Yeah, that's so. Talk a little bit about the process. If I wanted to participate in Tapioca DAO, like let's say I wanted to mint the USDO stablecoin, what would the process be? What happens in the back end? Like for example, if I want to move it to like say Solana or like Arbitrum, what the process is for that as well?
Yeah, so this is where people's minds get blown. So this is what we through Layer Zero, what we've been able to do. So let's say I'm just going to make a theoretical example just to explain this easiest. So let's say you wanted to supply Sol on Solana to mint a stablecoin, and then you want to lend that stablecoin to against a collateral asset that's on Base, and you want to do that, right now. Well, right now you would have to take the Sol, borrow against it on Solana natively, then you would get the stablecoin, then you bridge it out to Base, then you lend it to that other protocol, and now you have you have your collateral over here. You're taking 20 steps to do that.
And then each one of those steps incurs like a small fee, which adds up quite a bit. Yeah.
Gas, time, just doing it in general. So with Tapioca, what actually happens is you're able to, in one transaction, you're able to, let's say, supply Sol, mint USDO on Arbitrum, then lend that USDO on Base, and then lock it, let's say, for our call option incentives, which we'll get to later. But basically, you can do all of that. So 3 networks, all in one shot, in one transaction. You incur no fees, bridging, nothing. Like all at one shot. And you could take any number of chains. Like you could say Base, Arbitrum, and Ethereum. You could Barachain, Monad. You could throw whatever combination of networks you want there. And you could all do all these steps in one transaction just from one protocol.
And it's powered specifically by the layer 0, the OFT standard of token, correct? So basically in the back end, the chains are able to communicate and reach consensus with each other, so that each individual step you don't have to go through the physical process of bridging, moving liquidity, and stuff like that.
And to explain that back end wise, how this is working is, so we'll take your collateral asset on Solana, and we'll wrap it into a OFT token. So we'll take your collateral, put it into an OFT. We'll send the OFT to Arbitrum. Then we'll deposit that into Big Bang, which is where we create USDO in a CDP or a loan. And then basically that USDO is then minted. Then we take the USDO, which is an OFT again, and we send that OFT to Base, let's say, and then we lend it into our Singularity markets, which are lend borrow markets. And then basically, so it's all powered by OFTs and something Layer 0 V2 does, which is called compose calls, which basically means you're composing or chaining actions together. So the mint, the lend, the lock, it's all being chained in that one transaction. So.
Yeah, that's very cool. So at launch, what exactly what forms of collateral will be available, and what chains will be offered to the users?
Yeah, so basically when Tapioca begins, it's going to be kind of in a guarded state, meaning it'll just be same chain experience on Arbitrum, and the collaterals will be ETH, RETH, and wrap staked ETH to mint USDO. But basically within 30 days, we're going to be turning on Base and Ethereum. And then from there, basically, we'll just keep adding more and more networks to that. It's basically just kind of like flicking a switch, just because it's just adding basically that wrapper I was just discussing before. We basically are just adding a link chain to that, so that take ETH, for example, we say, okay, ETH from Blast is supported, or ETH from Base is supported. And then you can mint that wrapped asset and then do all this stuff. So it's very easy to chain stuff together.
Is collateral going to be limited to Ethereum for a while? Or are you looking at other assets? And do you have some sort of analysis or risk assessment as to what assets you would accept as collateral to mint USDO?
Yeah, so to mint USDO, it's only going to ever be gas tokens and liquid staking derivatives. We do basically the first 2 networks we plan to support that are non-EVM are Solana and Barachain. I mean, Barachain's an EVM, but it's IBC based and such. But basically, what we're doing there is so Layer 0 just released beta support for Solana, so we're already building that to support it when it comes out of beta, and then we'll have native Solana support. And Barachain, as soon as they go mainnet, we'll be supporting that as well. And then basically we're hopeful that networks come and approach us, because there's a lot of networks and not a lot of apps. So, we're hopeful to kind of get in that incentive game with all these networks coming out. But the other thing too is from a risk perspective, what I was just talking about previously with Chaos Labs. So they basically always do all of the parameter recommendations of this is what we should support. This is the LTV. This is the interest rate. This is the debt ceiling. Yada yada.
And like a lot of that is just like based on like the on-chain metrics of like how liquid the token is, like how it's used and stuff like that. Yeah,
exactly. Yeah, and that's why we only have gas tokens and LSTs, is
uh-huh.
because a lot of people will be like, well, why don't you support like, let's say CRV or Aave or
Uh-huh.
whatever token? They're liquid. Well, the thing is you can always depend on a gas token to have demand, because the demand is equal to the demand for its block space.
Mm-hmm.
So there's always liquidity to liquidate. There's always demand to keep the price, that the price isn't super volatile. And it's a very easy way to create a framework that you can't have like, a CRV creep its way in, and then you have what just happened where, the Mitch is getting liquidated for like $100 million and there's no liquidity.
Yeah.
So
I feel like that's also like a pretty big issue. With like these protocols is that they generally like decide. I mean, I'm not sure exactly what goes on the back end, but they generally decide on what collateral they use based on like stuff like market cap and like on-chain liquidity, without looking at like the actual like token distribution, or you know like which portions are vested with like. And I think the Mitch situation was like a good example. Like, I guess most people would think that Curve is like a pretty reasonable, like non-volatile asset in order to have, and then
it's
like
liquid, but
it's liquid, but like if like one entity or one individual has like a huge percentage of like the on-chain float, and it's entirely deployed, like that's a huge problem. And like like it leads to, I mean, like we saw the fallout like quite a bit. I guess like not that much bad debt was generated, but like it was pretty bad for.
It could have been worse. It could have been worse. And that's the big thing. Like we have said from day one, TAP, which is our like our token, will never be used in a lend borrow market or to obviously mint USDO, because it's very circular. And if a lot of people don't remember, like Itchy and Rari way back, where Itchy had that fuse pool and the token was like 10xing a day, and then it death spiraled and went to zero. Like it's circular. You can't issue your own token and then back your own token with that. It's just very, so that's where I think, it has to be looked at on gas tokens too. Like Sol, you could say, okay, well, FTX creditors are about to get a bunch of, vested Sol. So what's that going to impact the price? And that's something that Chaos, thankfully, like does look at with us, is like distribution matters a lot, much more than just the on-chain liquidity. Like, what's the utility? What's the demand for the token? Like, take ARB. ARB is another token. Like, what's the utility? None.
Yeah.
So what?
Yeah,
I
feel like that might be a whole another discussion, but I don't really understand the It seems like you speak something about like Arbitrum. The chain uses native Ethereum to pay fees, and then like if you look at the Arbitrum Foundation, like their business model is essentially incentivizing people by like paying out the ARB token, which is like net negative for holders of Arbitrum. So it doesn't seem like it doesn't seem like that there's much like I feel like that this model is like similar to like a lot of like L2s and L1s, where like like you have a centralized foundation, like a treasury holding mostly their native token. Like it may not be the gas paying token on their network, and then like their business models essentially incentivizing users by paying out like millions and millions of dollars in their native token, which is, I mean, it leads to short-term adoption, and I don't know if it leads to long-term adoption. And
it's like, where's the payoff? Like, is it we take an L2 fee and then we pay that to people who stake our token? Or like, there has to be some type, and that's why with TAP, like the whole model was like linchpin, like what is going to be the point of this token? And we were like, okay, you get our token, you lock it, we'll give you all of our yield, like all of the protocol fees go to you and get paid out in USDO. So our stable coin, so people could just lock USDO and then they're getting paid out, the interest we get paid off, people minting the stable, people borrowing, liquidation fees. So they just get all of it. And that creates a very easy, like, okay, what's this token worth? Well, what's my yield per year? There is no speculation. I mean, you can speculate,
it's like a mathematical equation. I guess we can move on and talk about the TAP token, because I think the design is pretty interesting. Um, I'd say the closest comparison is something like Curve that has like a certain vote lock mechanism. I guess like the main difference is that there like aren't emissions, and like there's like a time weighted lock on tap.
Yeah.
And obviously like I believe you're paying out like a much higher percentage of the actual fees generated by the protocol to the token holders. Yeah, so like I think we talked about this a little bit before, but this sort of relates to the fact that like the points model and the like airdrop model, and then like just like printing these tokens and incentivizing pools, it seems like a bit of an outdated and unsustainable model. So talk a little bit about how like the tap token works, and how you think it's a bit different than like what the current standard is.
Yeah, so a lot of people found out about us, I think not even from like the layer 0 stuff and all that stuff, but from, I did this article like 2 years ago called Death of Liquidity Mining, and then I outlined like the problems and how to fix it. So what basically we adopted is a call option incentive model where you're not getting free tokens just blasted out. It's all based on call options, and it's all based on people locking either USDO or TAP. So basically how it basically, and where that plays into the model is decentralized stablecoins. One of the way they create fees is leverage, and the way you get leverage is liquidity. And it's like, well, okay, who's going to LP like your stablecoin? You have to pay them to. So with us, basically, we put out call option incentives for people who lock USDO, and then they basically settle these options. We get protocol loan liquidity, and then we use that protocol loan liquidity to create USDO liquidity on many chains. And then that means people can get more leverage, and that means we create more fees, and we can pay out TW tap lockers more yield. So that's kind of the symbiosis of the model. And basically on the TW tap side and kind of the TWAML stuff, how it works is it's basically, instead of like with Curve, it's like you lock for 4 years, you lock 100 CRV for 4 years, you get 100 VE CRV. And that never changes, no matter if it's Mitch is getting liquidated with 100 million or it's the top of the CRV wars.
Yeah.
Like it's always 4 years. So with us, basically the time to lock tap always is changing based on market demand. So it may be you can get a max output for locking for a month. It may be 4 years. It may be 2 years. It's all dependent on the market, so that we're constantly vacuuming up the tap supply from the inflation of the call options. So it's kind of like that. And as well, the other thing too with the call options is because call options have a strike price, that creates a price floor, because if the token goes below the strike, then the options are worthless. It creates a sustainable way to inflate the supply, target what we want to target to grow the protocol, but not in a way where it's just like millions of dollars in sell pressure, untenable, tokens falling, but the inflation's still going and making the price worse and worse and worse. So it allows us to create kind of a lever to kind of ride a careful line of, we inflate when things are going well and we're creating more pull. But if things aren't going well, then the time to lock decreases, the inflation decreases. So it's kind of always kind of modulating. And where I got the idea from was Olympus with bonds. Bonds were a great idea. It's just they were very unsustainable, because it's basically just like a coupon. Like, here you go, we'll give you 50% off whenever. Whereas options kind of create a price floor, and all those types of attributes. So that's kind of where and I think what people like about it a lot is because it's bringing in pull, and the pull's never going back out. That more and more liquidity, we're going to get more and more fees. So as long as the market rates don't drop anyway. So basically, it's kind of predictable of that. The fees can kind of keep growing and growing and growing, and that means that we're kind of counterbalancing the inflation more and more, which is constantly dropping. So that's kind of the whole thing.
That definitely makes sense. I feel like that might have gone a little bit over like some of our old watchers' heads. So maybe I can like clarify a few things. So like, as far as I understand, the call option is given to people that like you have like a money market where people can deposit, people can borrow, and
Yes.
their funds are like completely liquid 100% of the time. And so
Yes.
you can participate in like Tapioca DAO and not have to deal with the token, not have to deal with the call. You could use it as a like the same way you use Aave or Compound, right? It's
Yes.
just like a money market. However, if you do want to like if you want to align your incentives with the protocol, and you want to lock a certain position in, whether it's like the so like specifically in this case, like USDO, you get a call option based on the amount of time you lock these assets. And like
Yes.
a call option is basically like a price that you're allowed to buy tap with, and it's usually at a discount from spot, and the discount
Yes.
like varies based on the amount of time you lock. So the longer you lock, the bigger discount you get.
There you go.
So when you say that there's a price floor, it's essentially that if a lot of liquidity gets locked, like there's no reason for people to lock liquidity unless they see value in the call option, right? Because like if they would just want to participate in the money market, like locking liquidity just ties up your liquidity and you can't use it elsewhere. So that they see they see value in the call option. The call option being just an option to buy the token at below the current
Below the market
price.
value.
Yeah,
Yeah,
yeah.
and then that strike price. So like the max discount's 50%. So let's say Tap's like $1. Well, then the strike price is 50 cents. So if Tap hits 50 cents, all of those options are worthless.
Yeah.
And then you have a price floor.
Yeah. So it creates like a pretty interesting dynamic. Just because. So like going back to like the previous discussion about like the points model being broken. Basically, people were depositing assets on like whatever chain or whatever protocol in order to gain the token, and then like the model was to, after the points program is over, basically move your assets to like a new points program or a different points program, and most likely sell or like solely liquidate the native token, which like causes a temporary increase in TVL on like one protocol until the points program is realized, and then like a net negative like going forward. But in this case, it seems like you're attempting to attract, like because it's a call option and it's not an airdrop. You're attempting to attract people that actually believe in the protocol, that are like willing to tie in their liquidity and pay money for the token at the end of this like lock period, which you can sort of call like a liquidity mining period, because you're liquidity mining for like the call option rather than the token itself. So it sort of like aligns the incentives of both the LP providers, the protocol, and then like the token holders itself. Would that be accurate?
Yeah, and to tie that together, so basically the protocol wins because it's getting protocol owned liquidity. The users win because the more liquidity is, the more fees they get, and or I'm sorry, the token holders, and then the LPs win because they're getting in the money call options, which mean profit. So everybody wins together, and like we were saying before, so basically the inflation is constantly trending down, and it's a fixed supply, so this can't just happen forever. Like it'll end at a certain point, and we've gained enough protocol on liquidity that basically, we don't need to incentivize this anymore, because if we have $500 million in pull, we probably don't need to keep incentivizing people to keep lending. We could just continue growing.
The protocol itself will be generating enough income from like the protocol on liquidity to justify the valuations and stuff like that.
Yep, exactly.
That makes sense. Like so for the listeners, the pool or protocol owned liquidity is essentially liquidity owned by like the DAO or owned by the protocol that's deployed like also in DeFi that generates yield. So in theory, the larger the number is, like the bigger the DAO or the bigger the protocol grows, the more fees can be generated by the protocol owned liquidity, and that'll go back to the token holders to a point where, like at the point where like the token supply runs out and you can't keep issuing these call options anymore, then the protocol sort of sustains itself, because it has like it in theory, if all the call options like by the end of the like whatever cycle you have are are bought up, it means like the protocol is doing well, right? Like it means like there's tons and tons of protocol liquidity, and if the protocol isn't doing well, then like the call options will expire as worthless, and like the I guess the like the you know the runway for these call options would be extended over like a longer period of time.
Exactly. Yep. And the really cool thing I think too is basically, you know, like with having all this protocol owned liquidity, it gives you a lot of control over the stable coin itself and all that to actually expand all these chains, because you need liquidity on all these chains for USDO and the protocol to work. So you know, you have that side of it, and yeah, it just keeps extending and extending out if these call options are expired. But the cool thing I was going to add is we actually, so for our airdrop, I also hate airdrops how they're done. We did the first call option airdrop. So we actually did this incentive model as an airdrop, and I was blown. I thought probably 30% of these options would get redeemed. We had 90% in some phases. Oh, wow. The token was going up the whole time, which I was pretty shocked by. And the protocol brought in, I want to say, about $2.5 to $3 million from this whole airdrop within 6 days. 6 days. I mean, it was a massive success. And I couldn't even believe it. And it basically set people up to understand how the incentive model will work, like after this. And people are really happy with it. Like a lot of people at first, when I talk about call option incentives, they'd be like, oh, this is so complex. People are like, oh, I got my OTAP call option tap NFT. I exercised it. Easy as pie, you know?
Yeah, that's awesome to hear. One thing I wanted to go back on is the how exactly, I believe you call it the AML, the average magnitude lock.
Yeah.
How is that exactly calculated? Is it like an automated process, or is it like, you know, decided in real time by, you know, someone?
So it's basically a system of votes. It's like a cumulative. So if me and you lock for 4 weeks, that's like our vote of where things should go, and we're basically voting for growth. That like the lock time should be longer. And then basically, you know, let's say everyone votes and says 4 weeks. I'll max lock for 4 weeks. So then the next epoch or week, the max lock time will then be 16 weeks. And then people again go, okay, am I willing to lock for 16 weeks? You know, yes or no.
I see.
If people start locking, let's say 8 weeks or 4 weeks, it'll start decaying, and it'll say, okay, next week, okay, it's going to be 10 weeks instead of 32 or, you know, whatever. And basically, and then when we unlock, our votes basically are removed and the cumulative goes down. And then basically it's like, do people lock again? Do they lock shorter amounts of time? And that's how basically we're always gauging what the demand side is to keep the locks growing, to lock more capital with more people longer. Like what's the time frame to do that?
Yeah. So when you say votes, you just mean like in essence, if I'm a locker, my vote is essentially like how long I lock for. That's my vote for the duration, right? So then like you just take look at the, after each epoch, you just look at like the data of like X% lock for this amount of time, X% lock for this amount of time, and then like going forward, we'll decide like what the maximum or what the optimal lock time is, and then that sort of resets, and you go through the process over and over again.
Yeah, and this is all automated, so it all does this by itself. It actually was based on, funny enough, chess rankings, like ranking.
Oh, really? Well, like the ELO, yeah.
Yes, yeah, that's what it was based on. And basically, we created this whole mathematical formula based on that to do it. And yeah, I mean, it's going to be really cool to see it, like you know, in play. And how it all, you know, kind of fleshes out. And that's something where Chaos Labs has been helpful a lot as well in analyzing it and that type of stuff, because it's very different to what's been out. But you know, I think the whole point again is just alignment, is two things, like growth and alignment, that people are willing to lock their capital for this period of time, versus like liquidity mining, where it's just like, okay, I put my dollar in the box, and then the box gives me $2 out, and then when it stops, I take my money out. Like,
That's very reminiscent. I'm not sure if you've seen this clip, but it's like
Yeah,
Sam Bankman-Fried talking about how DeFi works, and like
that's where I
part of
got
it
it
was,
from.
yeah,
Yep.
okay, okay.
Yep. I thought it was really, as much as I hate the guy, I was like, he's got a point.
That's how it works. He's not incorrect.
No, he's not. And that's
Yeah,
how a lot of protocols are. It's like,
yeah.
oh, there's 100 million in the box, so the box is worth 100 million. No, it's
Uh-huh.
not. The box has no inherent value. Like,
Mhm.
so
Yeah.
yeah.
I want to talk a little bit more about the protocol owned liquidity and how exactly it works and how it benefits its users. So maybe talk a little bit more about like the process of like how that liquidity like it gets accumulated, gets deployed, and then like the fees eventually go back to the users or the tap holders.
Yeah. So basically, with protocol owned liquidity, at first it accrues into a multi sig, and there's a liquidity council that kind of like dictates where it's going. The
Mm-hmm.
big portion now is USDO liquidity, because USDO is a new stable coin, so we need to have liquidity for it so
Yeah.
we can get leverage and things like that. So basically, that's how it started. But what we want to do is have automated management. Like, okay, there's a lot of utilization on this AMM pool. We need to add liquidity here
Mm-hmm.
or add liquidity there, and what have you. And basically, how it benefits users is, very simply put, CDP stablecoins like a MIM, a DAI, whatever, LUSD. The big component to them is leverage. Is basically
Mm-hmm.
like, I want to lever my exposure to ETH or lever my exposure to
Mm-hmm.
wrap Bitcoin, whatever, wrap
Mm-hmm.
staked ETH. So basically, when people are leveraging, they're swapping out of your stablecoin. Like, they're
Mm-hmm.
giving you ETH, you're giving them your
Yeah.
stable, and then they're swapping to that collateral
Yeah.
asset. That creates sell pressure. So
Uh-huh.
you need enough liquidity to saturate all of that leverage, or the leverage won't work, because people will go, okay, if I take this leverage out, the stable is going to be 90 cents and
Yeah.
I'm losing money. So basically, the more and more and more liquidity you can, and this is something no CDP stable has addressed. You had Maker with the PSM, where they're saying, okay, give us USDC, we'll give you one DAI. But beyond that, Liquidity LUSD is very illiquid. MIM is extremely illiquid now.
Yeah.
So like, how do you get that liquid? How do you incentivize LPs to LP your stable? Well, you got it. We're right back to square one with liquidity mining. So with this model, we can get more and more pull, which is permanent. And then we can LP our own stablecoin on our own ranges, our own ticks. We control the peg because of that. Because with concentrated liquidity, we could just do, a dollar with USDC.
Yeah.
And then leverage, if there's 10 million in LP, you can basically take out about 15 million in leverage. And there you go.
it seemed like so for the listeners or watchers who didn't understand that part, like basically the main use case for these CDPs, especially when they're collateralizing Ethereum, is for people to leverage Ethereum. So like if you're bullish on Ethereum, what you would do is you would deposit Ethereum, like mint a stable coin, and then like sell the stable coin to buy more Ethereum, so your exposure to the Ethereum is a lot higher. And then eventually, if Ethereum goes up, if your play works, you're able to sell that Ethereum, repay the debt, and make
Profit.
a decent amount of money. The main issue with like the current CDPs, like if you take the example of MIM, I believe like their model for liquidity is they just set up like a pool and curve, right? And then they run like their native token incentives, so people provide liquidity. But like I'm pretty sure they're not like actively managing that pool. It's just like what people put in and what people put out of the pool. So like I mean, I think it's trading at still like pretty close to peg, but in general, like the pools are a little bit imbalanced because there's quite a bit more demand for people to be
and if
like
you look
selling
like
in.
right now, I'm just looking right now. This is MIM. So MIM has 10.5 million in MIM in their 3 pool, which is MIM, DAI, USDC, USDT. And then they only have 200,000 DAI, 200,000 USDC, and 600,000 Tether, which means nobody can leverage because there's no liquidity. And that's the problem, is they're incentivizing this, but people are LPing in wacky ranges that don't help anyone. So that's why.
Basically, like they're incentivizing the pools. So like they're using a third party, mostly Curve. I think they have one on like Balancer as well. But in general, the pools are skewed. So like the way curve pools work is they generally have like 2 or 3 like assets that are supposed to trade at like 1-to-1, and then that they have like certain ranges that they trade at. So like even if like the pool is, like you said, like like 10 million in one asset, like 500,000 in like another asset, it'll trade like close to 1-to-1 as possible until like certain points, which is basically it allows like a stable coin to function, right? Like even if the pool is heavily weighted towards one coin, like
it'll
being able
swap.
to swap exactly. You'll be able to swap your coin back and forth for like $1. But because like this is all third party liquidity, right? Like people are looking at this pool, putting in their own USDC, they're minting their own MIM to put in, essentially because they're looking at the pool incentives and that they think it's like a good risk reward to provide liquidity. But the ranges and like the value of the token and like the liquidity provided isn't really conducive to like what the protocol wants to do as a whole, or what like options the protocol provides.
And here's the big problem is, I think a lot of people don't realize this, is when you mint a stable coin against a collateral, you are short that stable. You're short MIM if you're minting MIM. Therefore, that's why people are more than happy to LP MIM, but not DAI, USDC, and USDT, because they're short MIM and then they're supplying it to that pool for yield. So they don't care if it goes down because they're going to make money when they repay. So it creates all these perverse incentives to do bad things that the protocol doesn't want. And that's the other big thing with Tapioca that we changed in the CDP model is we have this origins market, because basically people, a lot of, like, if you work this model out, you go, okay, so you got a bunch of pull. Well, now you have to mint USDO and you have to pay an interest rate, and you could get liquidated. Like, how do you actually create the liquidity? Well, we have this origin market where the DAO can mint USDO with ETH up to a 90% LTV, no interest, no liquidations. So that's actually where we can create USDO liquidity to then supply on AMMs. And it gives us a lot of control that way. And then, we can just, really capitally efficiently create USDO liquidity that people can use for leverage.
I think it might go over some people's heads, like how you're short the asset. So for people that don't understand that, if you open up a collateralized debt position and then you borrow like whatever stable coin from it, you're essentially short that stable coin, because that stable coin is like your debt. Like you owe that stable coin. So like, for example, if you mint like a stable coin that's pegged at $1 and it goes down to 90 cents, then like you've profited, because like you've minted a stable coin that's $1. You could have swapped it for Ethereum. You could have swapped it for whatever at $1. And then at the point where it goes down to 90 cents, you only owe back 90 cents on the dollar. So as the price goes like down, or as, like the value of your debt goes down, you owe back less. So like in the MIM example, if the reason, like theoretically, why there's so much MIM in the curve pool is because like people are essentially market neutral on the MIM at best, right? Because like they may think MIM is like a risky stable coin, but if you provide collateral and you borrow, like let's say you put in $1 million and you borrow 500K worth of MIM, and then you put like 500K into like the pool, if it goes to zero, or if it like loses peg, like you essentially have like a market neutral position, right? Because like your borrow amount also like goes down. So if MIM like catastrophically like goes down to zero, like you lose your liquidity position in the curve pool, but then like you also don't owe any money back into your actual collateralized debt position pool. So it sort of offers like I wouldn't say risk-free, but like you're essentially hedging your risk by like you opening up these positions and then depositing in these pools.
Yeah, nearly. And to make it even simpler, like, so basically when you open a CDP, let's say you owe 100 MIM, you always only owe 100 MIM. So if MIM is $50, then you only actually owe $50. But if MIM is $1, then you owe 100. So you want MIM to depeg, because then you only have to pay back $50 in value with that 100 MIM.
I think you mean 50 cents.
50 cents. Yeah, sorry. I was using an example of 100 MIM, but yeah. But yeah, that's where things get a little wacky. So and where we wanted to, and Liquidity V2's kind of going the same route we are, where it's like, okay, we need liquidity and we can't depend on third parties. We have to have the system is able to depend on itself. And it really changes the dynamics. I mean, look at Go. Go was depegged for 6 months. And and they had to blast an enormous amount of money to repeg it to get people to, so
that definitely makes sense. So the last thing I wanted to talk about is I guess the mechanics of like the borrow lending aspect of things. I believe it's derived from like Boring Crypto's Bento box, which was deployed, I believe, on. Is it deployed on Abracadabra? I know it's deployed on SushiSwap as well.
Yeah, so there's Bento box, and then Abracadabra had Degen box, and it's which is basically the same thing. Yeah.
So to talk about like a little bit about that, like its implementation and like how it I guess how it differs than like the more traditional models.
Yeah, so basically, what the very first thing we started building was Yield Box with Boring Crypto, which was initially called Bento Box V2. And the big difference is all of the positions are represented as NFTs, so they become fungible. The other thing as well is it supports, and you can actually deposit NFTs in it. You can deposit regular gas tokens. They don't need to be wrapped. It supports rebasing tokens, which is big for LSTs and LRTs. And basically, we built this before ERC 4626 came out, and that's ERC 4626 adopted, I think, some of the yield box models, but basically it came out to be pretty similar in that regard. But that's basically where all the collateral is stored. And the big thing with Yieldbox is it supports yield strategies. So people like we could say, okay, you give us DAI, we'll put it in Spark, we'll get the SDAI rate. You give us this, we'll do that. Like, so it gives us control over what we do with certain assets. And the other side of it is Cashy, which was the original market logic, like borrow, lend, that type of stuff. We basically totally revamped Cashy. There's very little of the original Cashy code still in Tapioca, but basically what we ended up doing was we have Big Bang and Singularity. Big Bang is where we create USDO, and then Singularity is the lend borrow markets. They actually use the same market logic. It just so they share contracts. It's just who's lending. Is it like the protocol minting the stable, or is it people supplying the stable? And basically, the great thing about both is they're isolated markets, meaning the risk is isolated. So we can put whatever we want in each market, and you're only accepting the risk of that one market. So we could do very complex strategies and stuff like that. And also the big thing with isolated markets that's great is like Aave, you still can't go to Aave and go, I want to go 10x long on ETH. Like you have to sit there and manually go bop, bop, bop. Whereas with Tapioca, you could say, okay, I want to go 50x long on SDAI. Boom. There you go. And it's one transaction.
It's all siloed into one market. So it makes sense. Like for the listeners who didn't understand, like the reason you can't do it on Aave is like, let's say I deposit Ethereum on Aave as collateral, and then like I borrow USD. The Ethereum that I deposit on Aave isn't just like sitting there like siloed in like one market. It's relent out, and like there may be varying forms of collateral used in order to collateralize like the Ethereum that like I don't realize. Like, I might not realize that if I deposit Ethereum on Aave, my Ethereum is actually like being lent out and collateralized by Curve, right, or something like that. Which like I think it's like an okay practice in theory, but like it doesn't allow things like leverage, right? Because like then you can't like loop your position, and like the risk parameters are just.
And that's what people want. That's what people want is, they want to go 10x long on wrap staked ETH or whatever and loop the LST yield. And that's what Tapioca does is basically you have a stable coin, you mint it, and then you just say, okay, I want to go 10x long, and then we over borrow up front the amount of USDO that you need to go 50x long or whatever, 10x long, whatever it is, and then we just do one swap and then boom, you're looped up in whatever asset you want.
The one click leverage feature, I think is an awesome one. Like I just remember like the first iterations of this where like you would want to loop something, you'd have to like manually go through the process. Yeah. And then it's just sometimes you like calculated it incorrectly, and then you got to go back and like do it again and stuff like that. So
you're doing it manually. You're swapping out, coming back, borrowing. And and that was one of the coolest things when we had our internal test net, and I was like, I need to go 50x long on SDI, and then just one click, and I'm looking at it, and this was on mainnet. Nobody knew it was deployed, but and I was literally getting like, I think SDI yields were 15% at that time, and I was getting like 600% APYs on DAI, and it was just, and even with the interest, it's like even with the interest at like 5-10%, you're still up 200% on DAI or something, and it just, nothing supports that yet, and that's why it doesn't, that those yields still exist, is because there's not really a protocol like vacuuming it up until now anyway. But
so for these strategies, like especially the leverage strategies, are they like curated by the protocol, or how do like who comes up? If I was an individual and I had like a specific strategy I wanted to employ, would I be able to deploy it at some point?
We do want to have a permissionless way to employ strategies down the line, but initially it's going to be curated. Like we're going to have like GMX V2, Aerodrome, Maker with SDI, a staked USDE. I have a crazy strategy for Athena where it's going to hedge it and go long and short at the same time. So then you're hedged on the downside risk on USDE. But I got tons of these like little strats that we've been building. That I'm really excited for people to try out, because isolated risk, go lend against it. You can go get, you can lock it up, get some call options every week. I mean, and
the cool thing about the isolated, like the markets being isolated, is like because like a lot of these are like pretty experimental at this point, you're just like sort of trying stuff out, and if something goes wrong, or like if some unforeseen circumstance happens, it's like it doesn't like destroy the entire protocol, right? Whereas like if you look at the curve situation, like that wasn't in an isolated market, like when Mitch got liquidated, that could have been detrimental, and like we basically killed every single market on like a lot of protocols.
And it's, and having it isolated, like it also ensures that like interest rate wise, that like Aave basically sets a min and a max interest rate, and you can't really do that when you're talking about going long and short on USDE at once. Like the market rate needs to be very adaptable.
You need like an elastic rate going.
And that's what we have, is basically the interest rate can be anywhere from 0 to 200%. So it can, be whatever the utilization of that strategy is, because the big thing people don't want is if the utilization goes to 99, you can't withdraw as a lender, because there's no liquidity.
The money's not there, right?
The money's not there. So you need to bat those borrowers out to repay. So then you can get your money out. And that's why you take the interest rate up to 200, then you're pushing those borrowers out, so then you can get liquidity out.
It's I believe like Fraxlend was the first to do that. Basically, they had like the doubling interest rate at like certain utilization.
They copied Cashy from 2020, but it's Morpho's done it now, and a lot of others. But Cashy did that first in 2020, which was I mean, Boring Crypto is probably one of the most like visionary developers ever, but they had that way back then, and they were doing like looped strategies on like Cream, if you remember Cream way back.
Cream Finance,
and if you did that on Aave,
cash rules everything around me, or whatever.
Wu-Tang Clan, But you did that on Aave, you would have blown the protocol sky high. But you could do that on Cashy, because the lenders get wrecked, and that's where, if you're a lender, you accept the risk of that market, and everyone's playing on. I mean, that's where people are trying to go, the Oracle list lending and all this stuff, which I think puts so much burden on the user that the user will never use it, because it's like set all these parameters. Like, I think it's just shuffling the risk over. Whereas if you have isolated markets, then everyone plays on one field.
Yeah, that definitely makes sense. Before I let you go today, is there anything you have planned for the future for Tapioca DAO? I mean, I know you're still like in its infancy basically right now, but like, are there any ideas or any innovations that you potentially want to do in the future?
Well, yeah, no, you caught me at a good time. So so we've been building this protocol since February 2022. So basically we had the protocol built by about last year, I'd say in June.
Mm-hmm.
And from then I've been basically cooking up the V2, and I've grown a lot as far as my knowledge on things, and then also everyone in the company, we're a lot more sharper. Like, this started off as kind of like a hobby passion project, and it turned into a very big scale thing. So basically, I was cooking up what the next thing is going to be for the past year. And I was basically going to develop like smaller protocols that complement Tapioca over the next like 6 months. But basically we've decided we're going to go right to the next thing. So, and I've been calling it the Zenith proposal. So that's going to be coming out after we do the relaunch, and we're basically going to go right back to building something that's 100 times better than even what Tapioca is, like right away.
Oh, wow. So, 100 times better. Wow.
Yeah.
Awesome.
No, I think it will be. So, yeah. So I'm very excited about that.
Yeah, I appreciate you coming on today. For the listeners or watchers here, let them know where they can find you, and I guess like any updates on Tapioca if they want to get involved, stuff like that. Thank you for having me on. This was really awesome. Definitely check me out, TW Matt with 3 T's on Twitter, tapioca.xyz. You can find all the Discords, the Twitters, the Git books, all that type of stuff. We have a podcast of our own called Tap Talk every week, so you can come listen to me on there. If you were able to burden this, listen to me this long, you'll probably like it. But it was really awesome to be on this. So yeah, I appreciate you coming on.
Thank you so much.